Hello everyone, welcome to this trade management mini session. Today we're going to be comparing a long call vertical and a short put vertical trade. We did two trades on the same stock on the same day. Both have hit their targets, and so we're going to look at how those trades worked out and have a conversation and compare and contrast these two strategies. I invite you to follow me on X if you aren't already doing so. My handle at Barb Armstrong CS. I'm posting content there on a daily basis that I think you'll find helpful and informative. Know just before we get to the Thinkorswim platform that options carry a high level of risk and aren't suitable for all investors. These example trades were done for example purposes only, not to be construed as a recommendation. We use the paper money software application on the Thinkorswim desktop platform. It is a brilliant place to learn as it looks and smells like it looks and smells like a real money account. One of the nuances or differences between paper money, though, and a live account is that short options will never be assigned early in paper money, and that certainly can happen in a live account. Okay, let's come over to the Thinkorswim platform, and we are going to start on the chart. So we looked at Lulu back on November 7th, and we put both a long call vertical trade where our strikes were at 310 and 315. Now, I don't know exactly where the stock was trading at that point because the range that day was from 312 to 323. But we tend to buy the first strike already in the money, and then the 315 strike would have been at the money strike. So it would have needed maybe to go up a little bit and then stay up in order for us to have a profitable trade. Our profit target in our example trading plans is typically 50%. Now with a short put vertical, and we put that trade on the same day, we put our short strike down here at 305. So about $10 below where it was trading on that day. And the goal with a short vertical trade, where here was the strike we sold at 305, was the expectation that the stock might stay above that 305. Okay, and it pulled back the next day and then came up. We hit our target on the long call vertical on, I think it was the 13th, and then closed out of the short put vertical right when the market opened today, because it might seem odd that we get out on a day when the stock is pulling back, but we got out right at the market open, 7 minutes after the market opened. And that is sometimes one of the advantages of having a target already in place. And so let's come to the monitor tab now and look at these. And so you can see, and we're on the account statement, you can see that we placed these two trades on the 7th, as I had mentioned, and I'm going to just bring up my drawing tool so that we can kind of whip through these. And so here's our first one. So we did this long call vertical. We did two of them. This is our call vertical. It expired on the 29th, and we paid, whoops, I didn't mean to have this in here, so let me start this again. Let me just hit my little eraser. Okay, my apologies. So here's the 7th. We opened, we had two contracts and we were risking $265 per share, and we had two contracts. So in total, we were risking $265 a contract times two, or $530. On the 13th, we exited that position with a credit of $425. So if we come and we look at this, just let me change my tool here. So for our long call vertical, how much did we make? Well, we made that $425 minus the $265 we paid to get in. And so we made a total on this one of $160 a contract. And then we had two contracts, so that totaled $320. And, for this small account, we consider that a nice base hit. And you know, what was it as far as return on risk? Did we get our 50%? Well, we made 160. We were risking 265. So it actually worked out to a 60% return on our risk. And so it slightly exceeded our goal. And it may have been that we had put in a slightly higher target. You know, when you're live in the market, sometimes the numbers move around a bit. Well, let's come now and look at the short put vertical. And again, like I said, we put it on the same day. We just did one contract. So why did we just do one? Well, we did one because we don't want to risk more than $500 to $550. And our risk on this was the $5 spread minus what we got paid to get in. So our risk on this was $345. And so $700 in risk was above what our rules allowed us to risk. And so that's why we just did the one contract. And then we exited that on the 15th, which happens to be today, you know, for 29 cents. So for this one, what did we make? Well, we made that $155 is what we were paid when we got in. And then we spent $29 to buy it back. And this is not taking commissions into account. So our net gain on this was $126. Okay. And how about return on risk? Well, we ended up net with 126 and we were risking 345. So that was a return on risk. Oh, I'm sorry, you guys can't see. Let me just move this number over. Return on risk equals 126 divided by our 345. And so that was 36%. 36.5 if you want to get specific. And so, you know, if you're just taking a look at this, you could say, well, gee whiz, why would I want to trade a short put vertical? I was risking more. I was risking $345 to end up making 126. Now here I was risking more, right? Because I was risking 265. So, you know, my risk on this was 530, but I made 320. I mean, you can't deny that, you know, this isn't quite double the return, but it's significantly more. So why, you know, would some consider a short put vertical to still be appealing? Well, one of the advantages that a short vertical has is that as long as it stays above the strike that, you know, you've sold, you've got a profitable trade. So it tends to be more forgiving. It tends to be a higher probability trade depending on where you place your strikes. So something can go sideways and still end up being profitable, where with the long vertical, they tend to be more directional. And in fact, with these two trades, we had our max probability of success with the long vertical if it stayed above 315. Our max success with the short put, it only had to stay above 305. And so these are just some of the things that you need to take into consideration. You know, in this particular example, both trades met their target and both strategies were successful, but it doesn't always work out that way. And, you know, we could have ended up had some news come out on this stock, and I'm going to do another mini session of a trade where news did come out and the stock dropped dramatically. And with a long call vertical, we did have more at risk. You know, so we could have ended up losing $530. And so all of these things have to be taken into consideration. And so with the long vertical, you know, this tends to be popular when things are moving more directionally. and short verticals might be pressed into play more when a stock is moving sideways, or, a short-term pullback, there may be some concern about that. So guys, I hope you found this helpful. Thank you for joining me. Again, these were for example purposes only. We'll look forward to seeing you in another mini session coming up soon. Take care, everyone. Bye for now.